Hi, this is Mike. I'm the Chief Investment Officer here at Lighthouse Financial. And I'm here with another edition of our market update. In fact, this is the year-end update, and we'll take a little peek around the corner at 2026 as well. So our talking points today are as follows. We'll review 2025, the triple threat of risks that came at us hard and heavy, but were then just brushed aside by the stock market rally. We'll ask the question, is this the beginning of a big asset bubble in AI? And we'll talk a little bit about the bond market and interest rates that are normalizing, which is good news for everyone. We'll go over the economy, and there's a question mark here because after the government shutdown, or during and after the government shutdown, we've had a little bit of a hard time figuring out the true health of the economy because a lot of the statistics that we rely on are not available. So we put the puzzle together a little differently. Anyway, this market is still prone to growth scares. We'll talk about that. I believe the good still outweighs the bad, and I think that goes into next year. And I'll say that most investors right now and commentators and financial news media are jumping to conclusions, which is not a good investment strategy. Just jumping off the diving board without any real rigor or waiting for real data to come in. And part of the reason for that is this government shutdown that's made everything a little bit more murky. We'll then look at 2026. And I'll say so far, Wall Street, pretty optimistic about our prospects for next year. And we'll ask the question, will the rally broaden out? How healthy will it be? All right, I've titled this slide, which you've seen many times, the embarrassment of stock riches. Despite all the fear and despite the corrections, we just had what technically had a bear market earlier this year, which you can see as that 20% correction. Despite that, since the bottom of that 2022 bear market, we're up about 90% in the S&P 500. And so while there has been a lot of negativity, a lot of pretty significant risk involved in investing, it's also paid to take that risk. Let's talk about the triple threats that came at us. The first was the change in tariff policy by the Trump administration that sort of hit everybody off guard a little bit in early April with, I believe, what he called the Liberation Day announcement. Anyway, the change in tariff policy essentially takes up our U.S. average import tariff rate up to levels that haven't been seen since probably like 1940. And so it's a big deal. Tariffs, as everyone knows, tariffs are a tax, and somebody's got to pay that tax, whether it's the manufacturer overseas, or it's the U.S. company that imports those goods, or whether it's the U.S. consumer. And we know that inflation over the last 5 years has been an issue. So who pays this tax? And when we first heard about these announcements, we were very concerned because depending on who you estimate will take this hit, that could really hurt U.S. corporate profits or consumer spending, both of which are critical to our investment outlook, which is generally positive. So we went through that, and then in the middle of the summer, the Bureau of Labor Statistics downwardly revised by a lot the number of jobs that it estimated our economy created from March 23 to March 24. 1 year period, and they revised down job growth by almost 1 million jobs. And that shocked investors. It made us wonder, is the labor market as strong as we had thought it was? Apparently not. And what does that mean? Does it mean that that our economy just doesn't have the ability to grow jobs like we expected that it did? And then does that also mean that it's getting worse, that it's deteriorating? So tough question to answer. We'll tackle that in a minute. The third of the triple threats is the government shutdown, which lasted a record 43 days. And the initial reaction, as you can see in this illustration, the initial reaction was the stocks kind of went down a little bit, bonds went up. That's, less risk was what that means. for investors, and the dollar weakened, commodities up and down, but gold especially has been rallying, and it rallied right through that crisis. So, normally government shutdowns are not a big deal for stock market investors. And in this case, it did not disappoint. But these were the three major risks that we faced here in 2025. So I'll say at the outset that, I told you the stock market just brushed all this off, and like it was almost like it was nothing. The only thing that really fazed us was the tariff announcement on Liberation Day, and even that has really faded from the narrative in the stock market. One of the reasons is retail investors, do-it-yourself investors, have become a lot more important within the overall stock market. They are, in terms of inflows, as I say at the right-hand side, putting cash into the stock market, and also trading volume, increased trading volume. And so this statistic really, really shocks me. On the lower right, retail investors currently account for about 20 to 37% of daily US equity trading volume. Before the pandemic, it was less than 10 much of the time. So obviously we could feel the onset of FOMO, and you got to get in now. You got to be in, whether it was in crypto earlier this year, or whether it's in AI, or private equity, or private credit, whatever it is. It's just, we got to be in now. And that bullish sentiment has carried through to today. You see the left-hand chart is just a survey of do-it-yourself investors, and you can see that there was a little dip there in February, March, April, but since then sentiment levels have really gained a lot, and so retail investors really helping drive this rally in a way that they haven't in previous cycles. Okay, within this embarrassment of riches in the stock market, okay, I will say that there's good and bad, right? The two sides of the coin. The good is that, look at this chart. This is sales growth reported last quarter, the third quarter of 2025, for all 11 sectors that make up the U.S. economy, and they're all positive. These blue bars are all positive, and some of them are really high. So on the far left-hand side, the tech sector is responsible for about 16% sales growth year over year. That's a lot. That's big deal. That's the good side. I mean, this is another one of those pillars for the stock market, is these companies doing well, growing sales, growing profits, and earnings growth. I didn't show you the earnings growth chart, but it's the same. It's very, very positive. Now the other side of the coin, though, is that a lot of sectors really are not, I don't want to say pulling their weight, but they're getting outshined by tech. And the tech sector is primarily, as you know, responsible for the early gains in AI. And so that's sort of understandable, but the market's also gotten kind of narrow. And what I mean by that is that if you look at gains in the tech sector, like stock market gains, far outshining other sectors. And so the market's getting more concentrated. The positive attention, the buying activity, the trade flow, the expectations for the future, all of that is sort of ratcheting up and concentrated in that tech group. So, and that's not all that healthy. You want to have, ideally, you want to have a rally where it's not just one sector that's dragging the index up. You want to have a good swath of the economy participating. And I think, by the way, I think we're finally getting that. But that's the risk of the market that we have right now, is it really is narrow, and it makes people wonder, is there some kind of bubble that's building in the AI, especially in the AI or the Magnificent Seven stocks, the 7 biggest stocks in the S&P 500? Is there a bubble brewing there where their valuations becoming so expensive, and so much positive expectations being built in that they have to be perfect in the future, or that you'll never achieve what those expectations are? That's what leads to a bubble bursting. Okay, so we measure valuation in terms of, one of the ways anyways, in terms of a price to earnings ratio, and that's what is shown in this chart. And the higher the ratio is, the more expensive. That means the more prices have run, but your ability to actually generate profits is lagging behind. On the other hand, when these charts go down, that means that your PE ratio is falling, you're becoming less expensive. So this has been a very bifurcated market, right? I mean, you've had the Mag 7 has a PE ratio of about 30, which is very much higher than the long run average for the stock market. And then the other 493 stocks within the S&P 500, their PE is about 20. That's still higher than the average, but it's a lot more attractive than 30. So 20 to 30, right? Okay, so big question is this a bubble? I don't think so, at least not yet. And I came into this business in the middle of the dot-com bust, which was an absolute textbook bubble, but no one knew it at the time. And we weren't talking about, is this a bubble? Do we have, my professors in business school were not talking about, are we outstripping valuations that are reasonable? Are we setting ourselves up for failure with all this hype just focused on tech stocks? This time, I think around, because we went through that in 2000 to 2003, I think people are asking the question, is this too much? Are companies vulnerable because they're having to borrow a lot of money to try to jump into AI? Are they acting in an irresponsible way when it's just a circular loop of money where they're all investing in one another and writing contracts to buy product from one another, but the money is all within that loop? Is that irresponsible? Is it going to get out of control? Are the PEs too high? So I just think this is different this time. And by the way, the PE ratio within technology before the dot-com bust was more like 50. So no, I don't think we're in bubble territory yet, but stock market investors are susceptible to a setback now and then. And if you've been paying attention this month, AI names are taking a hit. Oracle reported a great third quarter, but the stock has given up all the gains and more after that announcement. So I think we are vulnerable to a setback now and again, but that is healthy and it keeps us from building a dangerous bubble, which can then lead to a crash. Let's check in the bond market really quickly. This chart is a little bit complicated, but basically what it shows is that a year ago, the orange line, short-term interest rates were pretty high. In fact, in some cases, they were higher than long-term interest rates, and that makes no sense. That is a symptom of a market where inflation and interest rates are a little out of whack, and it happened because coming out of the pandemic, inflation ballooned in this country, and it had to be tamped down. The Federal Reserve raised short-term rates to do that, but I think I can safely say that we're pretty much past that crisis. They brought inflation down from a peak of 9% down to somewhere between 2.5% and 3%, and now it's time to drop interest rates and back down to what I would consider more normal levels. So the blue line is where we are now. You can see that those short-term rates, all the way from 3-month loans or bonds up to probably 5-year Treasury yields are much lower than they were, and that's good. We're just resetting things back down to normal, and the result of that is lower borrowing rates for consumers and businesses. The blue line here is new car loan rates by commercial banks, and you can see earlier this year that maxed out at 7.8%, and now it's back down to 7%. The average 30-year mortgage rate is the orange line or gold line, and that peaked earlier this year at 7% and is down to 6.2%. So this is good. It's good for consumers and businesses. We also like to check in with the bond market just to see, is there a lot of stress out there in the U.S. financial system? You usually can figure it out by looking at a few bond indicators. And in this case, those lines moving consistently down, except for, you can see early 2025, that tariff scare. The lines moving lower just shows you that no, there's not a lot of stress in the system. When we look at junk bonds, when we look at treasury bonds, when we look at even measures by the New York Federal Reserve Bank's proprietary measure of financial conditions, everything looks fine. That is everything within the financial system, but there are pieces of our economy that are not doing all that well. So manufacturing, transportation, parts of the real estate market are just not doing all that well. And I'll highlight again this blue line. It's a survey of manufacturing business leaders, and they ask them, is business getting worse or better? Are you contracting or are you expanding? And the answer for the last 3 years has been contraction. And the U.S. manufacturing sector has not been doing well. And it's a good thing, by the way, with the orange line, that services businesses have been doing a little better. And services businesses, you can see that suffered a little bit earlier this year, but is finally picking up. Part of this is tariff related, but part of it is structural. Again, it's just a good thing that you and I spend a whole lot more on services than we do goods, because the services side of the economy is doing okay. I would call it moderate, slow to moderate growth is what I'd characterize it as. We need to check in with the job market because it's an obsession of investors ever since the Bureau of Labor Statistics reset all the job growth numbers lower last summer. Okay, so here we go. The cumulative number of people collecting unemployment insurance, you can see it's rising. Okay, this is since, well, what is this, a 3-year chart? You can see over the last 3 years that it's been rising. It's a pretty gradual rise in unemployment insurance claims. If you look at the most recent, like weekly data, pretty good. It's pretty low. This is manageable, and I would call it manageable, but the trend is definitely up. The lower chart, this is the BLS. Just they say shut down for a while, so there's missing data here, and we've all been trying to figure out, how are we doing with monthly change in payrolls? Are we generating new jobs in this country, or are we losing jobs? So that's been kind of hard to figure out because there's some missing data points here. Especially in October, we'd love to know, but we don't know yet. Here are another couple of charts that I go to. Job openings is the top white line. Job openings about 7.6 million. So those are unfilled jobs, and it's been that way for the past year or so. We've had about 7.5 million job positions. That's a little higher than usual. I think normal is probably around 4 to 6 million. So there are jobs to be had out there. On the other hand, there are layoffs, and you can see that's the blue line. Layoffs have gradually, but clearly increased over the last couple of years. Not to a point where we need to sound the alarm bells, but it's definitely something that we're looking at. We always listen to what CEOs say because they're boots on the ground for whatever industry they're in. And so this is a comment by Paychex President John Gibson. His business, that is, runs payroll services for a lot of small and medium-sized businesses in the U.S. And he says the small business labor market remains stable among firms with less than 50 employees. He says, we're observing an emerging trend of employers increasingly relying on their existing employees to work more hours. So weekly hours worked rose across all regions in October. That just gets back to this characterization of the labor market being a no hire, no fire environment. It's with all the risks out there, business owners, especially with AI coming, business owners are reluctant to hire a lot, but they're also reluctant to fire because demand out there is not bad. Consumer spending is still decent. Business spending is great, especially on AI. So, with demand still out there, you have to run a business. You've got to get things done. And so we're not going to see, in my view, we're not going to see that wave of layoffs that we used to right as a recession would begin. So this is another reason why I don't think a recession is right around the corner. We need to talk about corporate earnings. This is all good news, and this is one of the pillars of this stock market rally, and especially coming into the future. So this chart, 2 lines, gets at how does Wall Street, the guys who are paid to crunch numbers on this stuff, how does Wall Street feel about corporate profit growth over the next 12 months? Profit growth, to the extent to which the companies that make up the S&P 500, are they growing their profits, or are their profits shrinking? Well, they're definitely growing after a setback. You can see here in March and in April of this year, where those lines dip down. It's just been up and away. And the orange line is very similar to it. It's projected operating profit margin over the next 12 months. So profit margins are expected to increase over the next 12 months, and indeed they're already at record levels. So this is all good news. Let's check in with a couple of CEOs. Bank of America CEO Brian Moynihan, he's talking about consumer spending. All the spending is growing. Credit quality is good. Charge-offs are basically flat. That means that he's not seeing a sharp uptick in loans not collectible, in souring debt. So, but businesses and consumers alike. So that's good. Home Depot CEO said consumer uncertainty and continued pressure in housing are disproportionately impacting home improvement demand. I mean, you could probably put in tariffs as an issue within that group. Here's a retailer that is kind of stuck right now. Consumers are a little bit leery of big discretionary purchases, and so spending on big home improvement projects is down, and so they're stuck in that. And Amazon, on the other hand, said tariffs really haven't dented consumer demand, and they also, Andy Jassy, the CEO there, also noted that he says their prices really aren't up overall across categories very much at all. So that's interesting, because they should be square in the firing line of tariffs. I wonder though if, and he mentioned this, I wonder if mitigating factor for Amazon is the fact that they've got so many different vendors on their platform that it probably keeping prices low. As I said earlier, somebody has to take the hit for these tariffs. Is it the manufacturer in China? Is it the importer in the US, or is it the US consumer? And depending on the category, it could be a very different answer. In aggregate for Andy Jassy, he says, the consumer really isn't paying the brunt of the cost for these tariffs. So it must be the overseas manufacturers or sharing with the importers here in the US. Ulta Salons, Ulta Beauty, excuse me. This is a company that's been doing poorly, and all of a sudden reported great numbers for Q3. They said despite soft consumer confidence and a focus on value, customers are still spending on beauty. So we need to not jump to conclusions about the health of the economy, about how different policies are going to impact corporations, because it can be very different, and there are a lot of variables to be taken under consideration. You would think with Ulta that tariffs would really hurt them too, but it seems like the demand, as I said earlier, demand is still there. That's what Andy Jassy said too. Demand is still there. And finally, I got to throw in Broadcom. We have to look at an AI company. And their CEO said, we see the momentum continuing in Q1 and expect AI semiconductor revenue to double year over year to 8.2 billion. So that's 100% growth in that product sales year over year. And that's great. I showed you a slide last year talking about opportunities and risks. What do we think we have in front of us? And I'm going to show you where we were right and where we were wrong. On the left, first bullet, earnings growth accelerated. We were correct, they did. But we were wrong, first bullet on the right, earnings growth was much higher than expected. In fact, we're probably looking at somewhere around 13 to 15% this year, something like that. And maybe next year, the same thing. So I will say we were caught a little off guard by how strong corporate earnings had been despite the tariffs, how the economy has actually managed to grow quicker than economists thought. And that's the second bullet there. We were right that we would avoid recession, but wrong in that the economy was really, really resilient in the face of these tariffs. And I mean, it's hard. There's a few companies here and there where you listen to their earnings conference call and think, okay, that's tariffs, and that's bad. But for the most part, it's really hard to pick really direct negative consequences from that yet. And it could be that they're lagged, but we're just not sure. Okay, third bullet on the left. What we were right about, rates and inflation continuing to normalize. Yes, we expected that. It has come to fruition, and I think we can end some of that hand wringing over inflation and interest rates are too high, and so I showed you a couple of slides earlier. Borrowing rates are coming down, and I think that's going to be good for the economy, good for stock market and bond market, by the way. Okay, where else were we right? We did expect a growth scare based on maybe imposition of a trade war in 2025, and that did happen. We expected it to cause a pretty serious correction, and we wondered if that correction would last the most of the year. We were wrong about that. That's because the economy has been pretty resilient in the face of tariffs, and so has the stock market. It was a pretty quick bounce back, what we call a V-shaped recovery, where you go down quickly and you come back quickly. Finally, I think another place we're wrong, Trump policies, we're looking around and we just can't see how they're sparking business activity. The onshoring, the idea is to use tax cuts and tariffs to sort of benefit our own manufacturing sector. That just, I think, on balance, it hasn't happened yet. We're hoping that comes in 2026. And so let's talk about that. Our base case for 2026, markets are probably going to have to climb a wall of worry. I mean, that wall is, the bricks in that wall are like midterm elections, no hire, no fire job market, which investors will continue to obsess about. AI bubble fears. Also, in coming up here next month, again, we have another fight over debt ceiling and government budget. So I'm sure something else, there are always risks that you don't foresee, but I think some of the most healthy aspects of a rally or of this rally have been that investors are climbing that wall of worry. They don't disregard the risks, but they view all of the opportunities and risks and make a calculated decision and invest. And that's fine. That type of investing, climbing the wall of worry, is usually gradual. It usually does not lead to a boom and bust sort of cycle where you build a bubble and it has to burst. So that's kind of what we want to see. But also, you don't hear me saying that we're going to be up another 10 to 15% next year. My base case is that we will not be up that much. I think the economy likely holds steady about 2% growth, but I could be wrong there. And I always have to ask myself, where could I be wrong? What surprise could there be for us? And I think if there's a surprise, it might be that economists and the Federal Reserve and Wall Street, we're all underappreciating growth and inflation in this country. We're all undershooting it. 2% is what the Federal Reserve says is a sort of the upper bound of our long run potential growth. Okay, but what if that's not the case? That's not derived at scientifically, and also the Federal Reserve's target of 2% inflation, they're trying to get it down there. That's also not scientifically derived. So I wonder if growth has been, economic growth, or what they call GDP, has been outperforming expectations consistently through the post-COVID era. I wonder if that might continue. If it does, you probably will get a better, probably will get a little bit of improvement in the job market and get a better stock market. That would be my guess. I think bottom bullet, Wall Street's probably correct. We're looking at another year of double-digit corporate earnings growth driven by AI adoption. And that's good to see, but we really need it to broaden out. And I think we will. Right now, everyone's out in AI land is busy buying chips, building servers, and trying to figure out how they're going to generate electricity to create compute power, right? That's all infrastructure. But what if we can get to a point where companies start using AI to improve their profit margins or create products to allow their customers to improve their profit margins? And what if, healthcare is always behind when it comes to technology. What if AI starts to be implemented in the healthcare sector to improve profit margins? That is a sector that's really over the last couple of years been forgotten about, and that could really come alive. So we expect adoption to drive innovation, and the whole point of this, what needs to fall at the bottom of the growth engine, is return on investment. We need to start seeing that all this money thrown at AI produces a return. So that's really key for 2026. We remain optimistic about next year. I just don't think we're going to get as higher returns as we did this year. All right, I want to thank you for watching. We're happy to provide this market update for you. Happy holidays, and we'll have another update for you in another couple of months. Thanks again.